Investors are raising concerns over the future of the stock market. Chase Wilsey is joining us now with what you need to know. You know, you're one of those people, like, if you're worried, I'm worried.
Yeah, I would say I'm generally pretty optimistic, and I'm a long-term investor, so I take a long-term view, but there's definitely some areas of the market to be quite concerned about at these levels, I would say.
Okay, what are the concerns?
Well, right now what I'm looking at is valuations essentially are as stretched as they've been since the dot-com bubble. So if you look at something called like the forward PE, that tells you how much you're paying for the future earnings of the stock market. That right now is around 22 to 23 times the future earnings. Historically, we're around 17 times. That's the 30-year average for it. We did hit about 25 during the tech boom, but that is the last time that we've seen 22, 23 times those future earnings. So things are just way too expensive in my mind. And if you look at something else called the Shiller ratio, that is looking at the last 10 years worth of earnings on an inflation adjusted basis, that's at like 39 times versus a historical average of 28. So things have just gotten way out of control, and it's so concentrated in these tech companies. The top 10 companies now account for about 40% of the entire S&P 500. So again, 10 is 40, that means 490 companies are going to be 60%. Even the top 3 companies, that is now 20% of the entire market. So you're so heavily reliant on these major tech players. If they have problems, that stock market as a whole is going to have big issues.
What would be contributing to this?
What would be contributing to this? I mean, it's generally just going to be, I think, fear and greed. I mean, that's generally how people operate. And right now, I think we have gotten very greedy. I mean, we talk to people at times, and they're like, well, you know, the value investing, which is what my office does, that's how we invest money for our clients. They're like, well, that's not very good. You didn't buy NVIDIA, so I'm going to sell out, and I'm going to go buy NVIDIA. Well, that is exactly what we saw back in the tech boom, where people are chasing these returns higher and higher, and maybe like an 8 to 10% return isn't good enough. You want a 15, 20% return, and it fuels money to go into this, and it creates bubbles. Now, are we in a bubble now? I think we're in the building of a bubble, and I think we are potentially going to see some issues over the next 5 to 10 years.
Okay, margins, I understand they're expanding. So what does this mean for investors?
Yeah, and it's not margins, it's margin. So margin is a way for people to borrow money and buy stocks. So
borrow money, buy stock, okay?
It is a very speculative way to invest because essentially you're borrowing money, you're paying interest in hopes that you can buy something to offset the margin cost.
Okay.
Right now, margin debt has topped over $1 trillion, which is a record. We saw the largest 2-month expansion in margin debt that we've seen. Well, it's probably one of the most top 3 that we've seen over the last like 30 years. It rivals what we saw during the tech boom in 1999 and also in 2007. Now, 2000 and 2008 were terrible years for the stock market. Margin in relation to GDP is another example. That is at the highest level we've ever seen. It's topped what we saw during the tech boom. And the big problem with margin is if all of a sudden that stock market starts to fall, you get what's known as a margin call. That means the bank calls and says, hey, we either want our money back, you're going to have to sell the stocks, or you're going to have to put money into the account. Most of the time, if people are buying on margin, they don't have the cash to put into the account, so it fuels further selling, and that stock market falls even faster. So margin is a very dangerous thing, and I don't like to see the amount of margin in the market right now.
I told you, you're worried, I'm worried, and next time you come back, because we can't do it today, I want to talk to you more about tariffs and how it's going to play in all of this. Chase, always good to see you.
Thanks for having me.